Ooh, hey everybody, welcome into Market Takes. I'm your host, Dion Rabouin. Thank you for joining me. I know you could have been anywhere in the world, but you're here with me and here with us on Market Takes, and I appreciate that. Look, we are diving into the U.S. retail sales report for October. Just came out this morning. We are already seeing some market moves right now, and I'm hearing a little bit of reverb right now, so just want to turn that down a little bit, but just want to dive into this report, talk about what the headline numbers were, of course, why today's retail sales report matters to stocks, the economy, markets overall. We're going to break all that down. We're going to talk about the market reaction, what we've seen from stocks, what we've seen from bonds, currencies, FX, what we've seen from commodities, crypto. We're going to get into all that and how it really impacts and what it tells us about the outlook going forward for the future, because we know markets are always looking forward, never looking backwards. Even though we get this data that's backward looking, we're always looking forward. We are also going to talk about, of course, the big picture, what comes next, and what this retail sales report tells us about what the Federal Reserve is thinking and what they're likely to do going forward based on the data that we've seen. So we're digging into all that today on Market Takes. Like I said, thank you so much for joining us. So look, let's just dive right in. First off, the headline numbers that we saw, retail sales grew by 1.3% month over month last month in October, and even 1.3% when you strip autos out of it. When you strip out gas, you also still had an increase of 0.9%. That compared to expectations for 1.2% growth, so we beat expectations just by a little bit, and expectations for 0.6% growth ex autos. Again, all that means is these sales were bigger than expected, and especially when you take out autos. So that kind of core index for what the retail sales are showing is rising higher than expected. That's a consistent theme that we've seen through CPI, the consumer price index for inflation, and what we've seen overall. So we're not seeing as much of this big pickup in things like gasoline and food and things like that that can be very volatile. Where we're seeing the increases on these numbers is in those core products, those things that are really at the center or at the heart of what the Federal Reserve is looking at. And so that makes this report a little bit more complicated than just checking out the headline numbers, as a lot of folks like to do. So we're going to get into just what all those things mean. One thing I do want to do before we get too far into this report is talk about something that I don't think a lot of folks really talk about when you talk about retail sales. Mostly we just look at that month over month number, but I want to talk a little bit about the year over year number. And I want to bring up a chart really quickly just to kind of illustrate what we've been seeing sort of longer term when we talk about the movement on retail sales. So as you're seeing there on your screen, you had that big pickup back in 2021. But if you look at the last few months, what we've seen on a year over year basis is that trend line kind of coming down pretty significantly. We saw that big increase to 10% back in July. And then from there, you've seen a notable kind of tick down. Now, we're not moving lower faster. Those reports are still showing retail sales rising by over 8% each month. You have that 10% number back in July, and then you have us kind of coming down a little bit over 9%, high 8%. And right now what we got for October is that number just a little bit above 8%. So just about 8.4%. That's important because, again, what we're illustrating there and what I'm trying to show is just the same pattern that we're seeing on the CPI report, that overall big picture inflation report, is kind of a similar theme to what we're seeing in retail sales. You had this big pickup, a kind of winding pickup into July, and then since July, you've seen the numbers kind of start to come down. They're not coming down very fast, but they are moving in the right direction. So that's a reason to be bullish. The reason to be bearish or maybe worried about the economy is because they are not coming down very fast. And like inflation, retail sales are still growing at a very rapid pace, and that's not going to bring us to the Federal Reserve's 2% target very quickly, and that's what it's all about. So listen, when we're looking at when we're looking at retail sales, just like when we're looking at any data, it's all about context and it's all about the big picture. Also, an important note, we saw this 1.3% pickup. That's the highest retail sales report since February, when retail sales rose by 3.8%. And it comes after 0% growth in September, which, is what the Fed would like to see. They don't want to see the economy fall off a cliff, but they want to see sales not picking up. Keep in mind, retail sales are adjusted seasonally, but they are not adjusted for inflation. So when inflation rises by 0.4%, as it did in October. You want to see retail sales rising by about that amount or maybe even less, because it shows consumers are pulling back, shows they're not going out and spending money. When consumers don't spend, companies can't raise prices, companies can't raise the amount that they're paying the workers, and that's what brings inflation down. So when we're seeing these numbers, retail sales picking up by 1.3% month over month, when inflation has risen by only 0.4% month over month, that tells you that retail sales are rising. People are still spending money by more than they would be, or more than the rate of inflation, and that's a worrisome sign for the Federal Reserve. So that's something to definitely keep your eye on. There's a little bit of on the one hand, on the other hand with this report. No individual piece of data is the end all be all, but we're going to dive into that. So listen, how does this affect the outlook for inflation? Because that's all anybody's been talking about all year. Inflation is the word and what matters for markets. This does complicate a little bit that peak inflation narrative that's gotten markets so excited the past few weeks. Now, it doesn't throw it in the trash, as we saw, back in June and July when we got those CPI reports. It was just like, oh, throw that peak inflation report in the trash. What this does do, though, is make things a bit more complicated, because you've got reason to be worried and you've got reason to be excited. This is going to put a lot of onus for interpreting that data on the Federal Reserve and on Fed Chair Jerome Powell, who we have seen have a bit of a hawkish bias, as in a bias for raising rates higher to make sure that they crush inflation, rather than, saying, okay, well, maybe we've done enough. Maybe we need to keep rates where they are so that we don't hurt the economy. Really, you're looking at this as, is it more important to crush inflation or more important to keep the economy afloat? Fed Chair Jerome Powell has said, I'm all here, baby. I'm all on crushing inflation. And when you get this rate right here, when you get a report like this, it suggests that inflation is not cooling very fast, but it is moving in the right direction. So I want to talk a little bit about this peak inflation narrative, right? That's what's got the market so excited. That's a lot of what's responsible for this rally that we've seen since the CPI report was released back on November 10th. You really have just seen the stock market just kind of pick up and take off, especially with those tech stocks. So that CPI decline, that really signaled, okay, maybe the Fed can slow down on raising rates. They've raised by 75 basis points each of the past 4 meetings. And now the market is expecting only 50 basis points. Normally, historically, they go at 25 basis points per meeting. The last 4 meetings, they've done 3 times that. So at this December meeting, the hope is, hey, let's slow it down. Let's cool it off a little bit. Then once we slow it down, well, that leads to stopping the rate hikes altogether. We go from 75 to 50 to maybe 25 to 0. And that's what the market is looking all the way forward to. Like I said, market's always looking forward. Once we stop, well, then we can cut rates. Now then, instead of keeping rates up at this high level, currently 3.75 to 4% on the federal funds rate, now instead of, continuing to raise rates or even not raising rates, keeping where we are, we can start to reduce rates. And that's what's going to boost those stock prices. And that's what's going to give tech and crypto and oil and all those things a big boost, because it suggests that the Federal Reserve is a tailwind rather than a headwind. And it's going to be helping the markets, making it easier to borrow money, making it easier for businesses to grow, rather than what they're doing right now, which is tightening the market and making all those things more difficult. So again, as we look at this one report, right, how does it fit in with the other reports that we've seen? Well, the Consumer Price Index and the Producer Price Index, CPI and PPI, basically what customers are paying at the stores when they're going out and buying things, and what businesses are paying when they buy wholesale. Those have both shown lower than expected readings for October. We also got the GDP report last month. If you were here on Market Takes, which I hope you were, where you should have been, we talked about that GDP report and why that was such a strong and bullish indicator for the economy. Check that out if you haven't watched that. So this retail sales report, those were just really strong and really confident for the pace of inflation slowing down. This report says, okay, inflation's slowing down, but it could be picking back up. That core number that we saw, ex autos, was higher than expected. And that number that we saw, ex autos and ex gas, was stronger than expected. And don't forget, we are starting to see a pickup again in gas prices. The amount of money that consumers spent at gasoline stations rose 17% in October from October 2021. So again, a little bit of on the one hand, on the other hand, right? If you look at that year-over-year number, which we threw the chart up on screen, you see inflation starting to slow down. But when you look at that month-over-month number, well, you had 0% in September, and then you had 0% a couple months before in July. And in between that, just a small increase, and then you've got 1.3%. That's a big increase. That's a little bit of reason to worry. That month over month number showing spending still strong, which allows companies to keep raising prices, wages to keep rising, inflation to potentially get out of check. That's a big part of how the retail sales influence inflation and why this report is such an important report and one to watch. This could give those hawks on the Fed. We've heard from Fed Chair Jerome Powell. We've heard from Fed Governor Christopher Waller. We've heard from Kansas City Fed President Esther George. They all say, oh man, this is bad. Inflation is getting out of hand. We've got to do something. We've got to bang down with an iron fist. And now this report lets them say, oh, well, you know what? Yeah, CPI, PPI, blah, blah, blah. Look at retail sales. Look at that 1.3% month over month number we got. Retail sales growth is still growing at 8%. That's something that they could say, and maybe that's a reason why they say, hey, we've got to keep raising rates at a very rapid pace and choke off inflation before it gets out of hand. So we could be seeing, and watch for this in the speeches, if you're watching what you hear from the Federal Reserve. Yeah, we've heard Vice Chair Lael Brainerd come out and say, maybe we've done enough. Maybe it's time to chill and pump the brakes a little bit on pumping the brakes. We've heard Fed Governor Lisa Cook come out and say something similar. You could start to see a little bit of a clash between the hawks and the doves on the Federal Reserve, folks who think it's much more important that we crush inflation, and folks who think, hey, well, you know what, we've got to keep some growth going in the economy and try to have a soft landing, maybe avoid that recession. Look for a potential clash in what you're hearing from them. Of course, the chairman is the most powerful vote on that board, and he seems to be very much in the camp of we have to crush inflation at all costs. So definitely something to watch out for. Look, let's look out on WSJ at the market really quickly before we get too late. I've been doing a lot of talking and I haven't been checking the markets, but there's definitely been some movement in the markets. We've got the Dow, the S&P, and the NASDAQ all lower. The NASDAQ down by 0.9%. We have seen stocks kind of bounce back a little bit from their lows this morning, but we are still moving lower on the stock market. I was watching bonds as this report came out. You've seen really across the yield curve, these prices, bond prices going up, bond yields coming down, folks saying, okay, maybe inflation's not that bad. Maybe we are getting out of the woods, especially when you look at those longer dated notes, the 10-year and the 30-year yield. The 7-year and the 5-year also up pretty significantly on the day. When you're looking at those shorter dated bills, and those are correlated to expectations for what the Federal Reserve is going to do, you're seeing just a little bit of movement. You're seeing the 2-year, the 1-year up 0 to 1 basis point on the price change. Yield not really moving around very much. As we go to currencies, the big move that we've seen really over the past couple weeks, as stocks have grown higher, the dollar has come back down to earth. You're seeing the euro out in front of the dollar pretty significantly, up near about 104 to the dollar. Remember, the dollar was valued higher than the euro for quite some time, for a little while there, and now the euro's back up pretty strongly over the dollar. We're seeing the Japanese yen down under 140 to the dollar, the British pound, the UK pound, the British pound up at around 118, close to 119. So we're seeing kind of reversal of that dollar strength. As we look out into the crypto markets, it's still a rough story there. You've got Bitcoin down about 2.3%, Ethereum down by 2.9%. But if you're in the crypto markets, you know 2.9%, 3%, that's not that big a move. There's also that story, the FTX story is obviously still weighing on crypto markets and probably will until we get some good news from that market that's fundamental in nature rather than some of these outside stuffs like economic reports. So that's the story right now. You're seeing there's not enough reason right now, I think, from this report for markets to say, throw our bullish narrative in the trash, we got to sell stocks and buy bonds. You're not necessarily seeing that. You are seeing some movement lowering yields on those longer dated maturities, 10 years, 30 years, but you're not seeing a major move because this report has a little bit on the one hand, on the other hand. Definitely watch gas prices and watch housing prices. That's going to be big because that's the thing that's keeping inflation elevated. We are getting some major reports upcoming this week and into next week on the housing market. So later today, we get the NAHB Home Builder Sentiment Index. That has been down for 10 straight months, and this month is going to be pivotal because that's now in negative territory. If the home builders aren't feeling good, they're not going to keep building. They might pull back and say, man, commodity prices are rising. We've seen the big increases now in natural gas, things like oil. We need to not build. Well, that means less supply coming to the housing market. Demand is still strong. You could see prices stay high or even move a little higher than they've been. We also get on Thursday, that's tomorrow, housing starts. And then on Friday, we get existing home sales. That's the big housing price data. So make sure you're watching those because housing has been probably the biggest contributor to inflation staying high. You'll want to watch that. Next week, the University of Michigan Consumer Sentiment Index, that is out. And you get another report on housing, new home sales. That's out on Wednesday. We will be off that week. That's Thanksgiving. I'm be with the fam. I hope you are and enjoy your time with you and yours. And then we'll come back the following week and we are going to hit you with that jobs report, the big kahuna. That's the big piece of data that comes out December 2nd. We'll be right here. I hope you'll be right here with us on Market Takes. Anyway, that's going to do it for me. I'm your host, Dion Rabouin. This has been Market Takes. Thank you so much for being with us, and we will do it again with you next time. I'll see you then.